What's Making Headlines? Your weekly wrap-up of the biggest news stories in the Australian mortgage and finance broker market.
Hello and welcome back to another episode of What's Making Headlines. It's Annie and Ben here today unpacking the big themes of the week. How's your week been, Ben?
Yeah, pretty good. It's starting to feel like the end of the year now, I think. But yeah, still a few big stories in there.
Still a lot of things happening. I think people are rushing now to get things out because, yeah, it definitely feels like we're getting towards the end of the year. I think most people pretty much already finishing up this week, some finishing up next week. We're pretty much finishing up next Friday. So we've got another one of these to come before the Christmas break. But there has been quite a bit of movement this week. And I think the big one that lots of people would have seen would have been the RBA cash rate decision. Now, no real surprises from the central bank this week. I think pretty much everyone was expecting them to hold, and they did. What were your thoughts on the actual statement first? We'll go into like what Michelle Bullock said afterwards, but like what did you sort of think about their decision? What was the reasoning behind it? What were you hearing on the ground?
Yeah, I think it broadly supports what we were hearing from economists in the lead into the decision. And sort of the RBA is very sort of conscious of what's happening in the inflation side of things at the moment. So I think that's really sort of shaping their thinking. And it was a unanimous decision.
Unanimous decision, yeah. And I think so 3.6% for another month. Actually, another 2 months because this is the December-January decision. So the next one won't be till February. And I think what struck me about the statement actually that they put out, I was like, it's way shorter than normal. Normally when they make the announcement at 2:30, they put out the statement on monetary policy at the same time. Not the full statement, just a statement. And yeah, it was like missing about 4 or 5 paragraphs than it normally has. Now, all the economists from the lenders will kind of go through the statement with a fine-tooth comb and then normally kind of like looking at the odd word that changes and maybe seeing if that changes the sort of tone and direction of the board. But this time around, there were whole chunks missing. It was just pretty short. I feel like maybe the RBA were going on holiday. They were like, we can't be bothered, just put out anything.
It's been a long year for the RBA.
Yeah, they were just like, you know what, no change, we're fine. But that kind of struck me first when I first looked at it. I was like, this is a lot shorter than normal. And also some of the language was quite different. So I think a lot of the time in the past, they'd sort of been talking about global impacts on and considerations of what they were doing on monetary policy. There wasn't anything really on international markets. It was all on domestic and the data. So perhaps that was why it was shorter. But I think also just looking at the fact that, you know, this means now in 2025, we've had just 3 rate cuts. And if you remember back in the beginning of the year, everyone was saying 4 or 5.
Everyone sort of had the whole rhetoric around, particularly after the first couple, was that we're part of an easing cycle now. And it's just going to keep going for a little bit. But yeah, it certainly seems to have shifted in the last couple of decisions.
Yeah, absolutely. Because I think if you, when we were writing about the first rate cut, which I think was in February of 25, most of the people were being like, terminal cash rate 3.35, maybe 3.1 in this easing cycle. We're still at 3.6. So way higher than we thought we'd be. And all this chatter now about whether there'll be a rate hike next. And I think most economists before this week had already shifted their forecast to be like, we'll think we're holding for a long time. And we'll see if there's going to be another a hike at all. I think ANZ were pretty much like, no, we just think there's going to be a prolonged hold. And most of the other major bank economists are saying that as well. I think there are a couple of outliers. I think Westpac still has 1 rate cut coming in mid-26. But the conversation recently has been maybe it's a hold and then a hike. Some people saying as early as February we'll see, which is the next rate decision now. People being like, maybe there'll be a hike. And I think what was really interesting after the rate call this time round was what Michelle Bullock actually said in the press conference. And again, a bit of a departure for her. Normally she's pretty reserved. She doesn't really give too much away. She doesn't really want to do too much kind of forward looking. But this time around, she was actually pretty forthcoming. I don't know what was happening at this Monetary Policy Board meeting this week, but like change in the air. And she was basically like, rate cuts might not be needed. So that's probably like one of the first times in a while we've heard Michelle Bullock be quite so forthcoming with what their sort of future policy stance might be. And she had said, there was actually, they hadn't even considered a cut at this week's meeting. They had only considered both holding. And I think they also did talk about hiking as well. I'm just going to read what she said. She said, "We didn't consider the case for a rate cut at all. We didn't explicitly consider the case for a rate rise, but we did consider and discuss quite a lot of circumstances and what might need to happen if we were to decide interest rates had to rise again next year. At this moment, given what's happening with underlying momentum in the economy," there's a bit of other stuff in there, "additional cuts are not needed." So that was pretty punchy for her.
Yeah, it would be interesting. Do you think consumers are ready for a February hike?
I am not. I am personally not ready for one myself. I don't know. I don't think they are. I think it would be a surprise if they hiked as early as February. And I think just from that language as well, she's saying we're probably not yet looking at this, or at least they hadn't this month. So I don't know in February if they will be. I think they'll probably be looking again at whether there needs to be a hike, particularly after they've got some more data. Because I think in the end of this month, we get more sort of economic data, I think in the form of,
So the quarterly inflation figures?
I think it might be the quarterly inflation figures. Thank you. I was a bit like, what is it? And then in January, we get more sort of economic data, I think, in from wages. So there'll be more things that they'll have to look at come the February meeting. So we'll be keeping a close eye on those over the next few weeks. But yeah, I think generally, looking at the cash rate trajectory, again at the press conference, Michelle Bullock was saying they're uncomfortable at where inflation is. It's higher than their kind of target band of 2.5 to 3%. Obviously, I think it's about 3 point something now, 3.2 maybe. So really being like, we're uncomfortable with inflation being where it is. Of course, November Black Friday sales and then Christmas spending also normally kind of sees a lot of activity in the retail market, everyone kind of spending a bit of money. So I think they're also just keeping a close eye on what does consumer spending look like? What does inflation look like? Are people finding it restrictive at the moment or not? And if they're not, maybe they might need to hike.
Yeah, and that was, I remember the last, it might have been the last decision she was sort of talking, Bullock was talking a lot about, they're not quite sure what the terminal rate is and what the right rate is. So they're still trying to figure that out.
Looking at the neutral rate. And there's been a lot of discussion about, is the neutral rate actually something that needs to be revised? Like, is it feasible? And also looking at the inflationary rate, like the target band being like, does that need to be revised? Is 2.5 to 3% too low? So I think like there's a lot of questions about that. But yeah, definitely I was just really surprised at how much she was giving away at the press conference this week. And again, I'll just read some comments from her because I thought these were interesting too. She said, "What we know at the moment, I don't think there are cuts for the foreseeable future. We're data driven. If you look back 6 or 7 months ago, things looked to be traveling in the right direction. Data changed, circumstances changed. When things change, you have to change your view." And a lot of economists were like, whoa, similar to us, being like, what is this? Like, it's so weird that we have normally a statement, firstly, that's so short, but then also that kind of is not really giving too much away, but then also having Michelle Bullock being super punchy, for her at least, in her commentary, like giving quite a bit away. So I think a lot of the economists were like, this is really hawkish, like language. Like we kind of thought, as I said, most of them thinking there'll be a prolonged hold, but they were like, she's talking about hikes.
Yeah.
So I think, no one yet from the majors, I don't think after the press conference on Tuesday changed their forecasts, but I think they will be looking long and hard at the data coming out later this month in January and maybe pricing in hikes.
Yeah, it'll be interesting to see where they time those hikes to occur, what point in the year as well.
I think if they do come, I just think February's too early.
Yes.
Fingers crossed, at least for me. I want a reprieve for a bit longer for my mortgage. But yeah, I think February's probably a bit too early. But yeah, lots of that was really interesting on Tuesday. And I think, as I said, lots of people now talking about, well, will there be a hike? Couple of people saying it's too early. I did see AMP's Diana Messina saying it's too early to be talking about this. And similarly, Bendigo Bank also said, their economist, David Robertson, was saying it's more likely there'll be rates on hold for 2026 than a hike. He was sort of saying it's too early. The market's moving too quickly to price in a rate cut or pricing in hikes, which they're doing now. I think the market's the sort of the yield market tracker on the ASX is saying 2 hikes in 2026 based on the market. So I think, I don't know. But yeah, David Robertson over at Bendigo was saying it's more likely that the season cycle's over and we're just in a prolonged period of stagnation now, of holding where we are. So fingers crossed that is actually what happens. Yeah. We'll take a quick break here. When we come back, we'll talk about some of the other big themes that people have been talking about this week and we've been writing about, including this special levy for the compensation scheme in last resort. And we'll get into that just after this. So this week we heard from the Assistant Treasurer and Financial Services Minister, Daniel Molino, who announced at a roundtable event on Wednesday, that the compensation scheme of last resort special levy will be applied across the whole finance sector. Now, if you haven't been following this, I don't know where you've been because we've been talking about it a lot, but the CSLR, the compensation scheme of last resort, had major blowouts in the amount of money they needed to compensate customers this financial year, because of a lot of the collapses in the financial advice industry. And this year they needed an extra $47 million. I think it's $47.3 million. Yeah. And they were like, in order to raise that money, we need to look at where we're getting it from. So they did a consultation earlier this year where they were like, we've got different options. We can either only put it on the financial advice industry, we can spread it across the whole industry, or we can kind of spread it like in payments over time. But they were like, spreading them over time is not great for the end consumer who actually is waiting for this compensation. They were like, applying it to just one primary subsector feels like that's a lot. And they were like, so extending the levy to other subsectors is kind of where they were going. And they did consultations on it. The broker associations had been providing feedback to it as well. And they were like, we don't want to see any kind of levy applied to brokers. It's not fair to basically make other people pay for someone else's mistakes. Yep. And they already have a levy, of course. This is on top of the normal levy. So unfortunately, depending on where you look at it, it is going to be spread across the finance industry. But the financial advice sector is the largest sector having to pay for it. So I think they're paying about 22% of the 47 million. And then it's kind of getting staggered across the other sectors. But for broking, I think I get the association's point. I mean, we did a lot of consultation on this. We don't want to see this applied to us, but it's only having to pay, I think it's 1.4%.
What does that work out for each?
$7 per credit representative. Okay, so, a very expensive coffee.
I think it's more sort of, I think part of it is just, that part of the financial services sector caused the problem, not the broking industry. So I think that's part of the problem, I suppose. Yeah.
And I think really it's kind of, they were saying, Daniel Molino was saying they want to spread it so it reduces the burden on any one sector. And particularly financial advice, we've seen, as of course, this issue's been raised because of all the collapses, but they've had a lot of pressure in the financial advice sector. And they're like, that's a lot more money to be asking for, and a lot of the time, small businesses to be paying.
Yeah.
So they're paying 22%. I think credit providers 15%, responsible entities 13.7%, super trustees about 13%, and all the other remaining subsectors about less than 10%. So as I said, mortgage brokers just 1.4%. I think the total is $667,000 to $529,000. So over $500,000 in total, which is still quite a lot.
Yeah.
But at least it's not millions and millions.
Yeah, exactly.
But we did hear from the associations, obviously, after this. So the MFAA, I think, was at the roundtable event earlier in the week, and they were saying, the Treasurer had said it was a difficult decision, that they'd kind of taken into account all the feedback from the consultations. And she was like, it's disappointing this has happened because, of course, this is an additional cost for members, even if it's only $7 per credit representative. Yep. But the aggregators, of course, will be probably paying the bulk of this. And they were like, really the issue here is going, well, this is this year, but what happens in future years? Yeah. And we already know that the 2027 levy is going to be about 3 times, the normal levy is going to be about 3 times what it was. So they're like, well, how are we covering that? Because are we going to have another special levy? Are we going to have a special levy every year if it keeps blowing out above these, caps of $20 million per subsector? So lots to look at now. And they're really reviewing how the CSLR works. What do you reckon the long-term solution would be?
It's hard to say because you can sort of see where they're coming from when they're trying to sort of spread it out across the different segments of the industry. But when you sort of see what that looks like in practice, you can sort of see how a subsegment that hasn't really done the wrong thing can feel a bit
Miffed.
when another one has.
Yeah.
But I think, they've been pretty open to the fact that they're still trying to figure out the best way to sort of apply the CSLR.
Yeah, I was just looking at the figures for 2027, the estimates for FY27 this is, and according to the estimates from the CSLR, the financial advice sector will need to pay a levy of $126 million.
Okay. Well,
and the cap is 20. So that in itself, just for financial advice, you're like, well, that's going to need a lot more money.
And if that sort of thing is happening every year, then...
then it's not sustainable. So they are looking, the government is looking at how are we funding this, because it's only been a being for 2 years. The first year, the government paid for the levy. The second year, everybody had to start paying the levies. And so we've only really had 1 full year of payment to the CSLR. But they're like, this is not going to work. Like if it basically everyone is paying for companies going bust, like, and they keep going bust, like this is just not feasible. So they are looking at reforming it, and there's having, I think the roundtable on earlier this week was having a lot of discussion about what does the structure look like, how can we make it sustainable, and there were a couple of things that came out of that which I think were pretty interesting, sort of looking at, well, do we bring in new types of businesses into the CSLR to start contributing to the scheme. So I think there was talk about SMSF sector, like superannuation sector, being like, well, can we look at maybe bringing this sector in? There was conversation as well about kind of looking at, well, are there any things that we should change in terms of what people are compensated for?
Yeah.
And I think particularly in financial advice, a lot of the questions we were hearing and issues that people were kind of coming to the CSLR for were things like, I didn't make as much money as I thought I was going to. And it's like, that's not really something maybe they should be compensated for, or is it? So I think this is another review being like, well, if it's that they're just not getting the returns they were promised, is that really something we should be compensating? So lots and lots to unpack here. And I think, again, like, you know, Peter White from the FBAA told our sister publication Broker Daily that he was like, the worry is about the precedent. And he's like, sure, it's not a huge amount of money this time around, but really we're setting a precedent here and we don't want to see this continue where every year we're having to stump up extra money for stuff that we've not done. So lots of chatter around that. I'd love to know, everyone listening, if you've got any thoughts on what you'd like to see the compensation scheme of last resort do, how you think it can be improved, because we're kind of out of ideas here, I think. It'd be good to get that. But that's not the only thing we were talking about this week. We did have some good news from the MFAA.
Yeah, so we got the latest broker market share figures from the MFAA. This is for the 3 months to September 2025. So it's slightly down on the record that was achieved in the quarter before. But it is still high, so brokers are now facilitating 77.3% of all new home loans, and the record was 77.6%, I think, in the previous quarter. But it is up 2.7 percentage points year on year and 5.8 points from September 2023.
So 2 years ago,
Yeah, so 2 years ago.
Yeah. So 5 percentage point difference in 2 years, that's a lot.
Yeah. When you think about it, and new home loans through brokers hit 130.23 billion, which is the highest for any September quarter. So yes, really big numbers, really, when you think about it. And I think we've become so used to broken market share sort of hovering around that point. It'll be interesting to see whether it can finally sort of break the 80% of all new home loans.
I think there's a lot of people talking about that and being like, I think earlier this year, lots of people were like, yeah, sure, we'll smash through that.
Yeah.
And I think now it's kind of slowly, incrementally hovering around this kind of 77 mark. People are like, well, maybe this is as high as we go.
Yeah. I was actually thinking about this the other day, and in my time here, I've just sort of become used to it being around this figure, but it's actually quite substantial, really, when you think about it.
Yeah.
It's most people,
more than 3/4. So definitely a lot of interest, and it's great to see, obviously, that people are still turning to brokers in their droves. And the September quarter, I think that figure about, the record amount of loans written, just really because the property market has been so hot, and we keep on talking about it, but it's true, like so much borrowing going on at the moment. And we did have some figures come out from APRA for the September quarter as well, looking at bank lending, the ADIs, and they also showed a huge amount of lending going on. So I think, let me just quickly find the number for you. So new lending was up 19% in the September quarter when you compare it to the previous year.
Yeah.
19%. That's basically a fifth.
Yeah.
So a huge amount there going up. And I think that's just for the banks. So if you add in the non-banks, it'll be even more. So I think in total for the September quarter, they wrote $196 billion, which was up from 165 last year. Now, part of that obviously is because of house prices. So the cost of what people are borrowing is going up. But yeah, that's massive, 19% up September quarter compared to September 2024. And also a lot of investor activity.
Yeah.
And we've been talking about that again recently, is how much lending's been going on. I think that we've seen about 40% of lending kind of being for investors. From banks though, in the September quarter, it was 36.5% or just over 71 billion, which was up 1.5 percentage points from the previous year. Whereas owner-occupied lending fell. So it used to be 62.8% in September 24. It dropped to 61.1%, but the actual overall number still increasing. So 120 billion written. But yeah, lots of interesting data from September quarter. Of course, data always takes a while to come through. So it's, about a quarter out by the time you get it. But
yeah. I think the next few data sets will be really interesting to observe with what we expect to be more new first homeowners trying to get into the market and lots of investors trying to get into the market, but higher house prices as well. Yeah. So it'll be super interesting to keep an eye on it.
Yeah, so we won't get the December quarter ones from APRA for obviously until about February or March, but I fully expect there'll be lots of owner-occupied lending because of the expanded first home guarantee scheme. Yeah. Sorry, the 5% deposit scheme, we're calling it now. Yeah. Because of that, and also lots of investor activity. But we do also have those curbs coming in, remember, in February.
Yes.
So this is to slow down high DTI lending. And again, we had a quick look at the APRA figures to be like, well, what is high DTI lending? And that increased. So the share of new high DTI, so when I'm saying high, this is debt to income of 6 times or more.
Yep.
That increased over the September 2025 period. So it went up 0.5 percentage points to 6.1%. So I think this is why APRA is looking at that and being like, we're going to bring in curbs in February to limit this to 20% of new lending.
Yeah.
So we're still a way off from that. Mm-hmm. But they did say at the time when they announced it that a couple of banks they are nearing that mark. So being like, we want to slow this down a little bit. But yeah, arrears seem to be all right. Like, still pretty low. Non-performing loans, 1.04%. So that's 0.08 points up. So it's still tiny. But 1% of non-performing loans, that's pretty good. And I think also looking at the 30 to 90 days past due, that dropped. So that went down to 0.4%. Yeah. So generally,
that's good.
Pretty good shape.
Yeah.
$2.43 trillion, though, is owed to the banks in mortgages in Australia, which is eye-watering.
Yeah.
$2.43 trillion. So, yeah, let's hope everyone can keep paying that because that's a lot.
Try not to think about that too much.
We'll take a quick break here. When we come back, we'll be talking about some more things from APRA, what's going on with the majors, and, of course, more about the incoming DTI limits too. We'll get into that just after this message. So just before the break, we were talking about the high DTI ratio limits that APRA is bringing in. I think we might have talked about this in the last episode of What's Making Headlines, but generally for anyone who's not been across it, so banks have to limit home lending of 6 times income or more to 20% of their new lending. And this is going to be applied separately to both owner-occupier and investor lending. Yeah. Now, I think, as we've sort of been saying there, most of the time, 6 times income. Okay, let me just do the maths here. So let's say I think the average salary is, I can actually look it up, but it's going to be quite, I imagine a lot of people will probably be borrowing that.
Yeah.
So average salary in Australia at the moment, according to this very quick search, is around, let's say it's $100,000. It says 102 to 103. So if you're limiting to 6 times income, that means the only debt you can take on is $600,000.
Yep.
I imagine most people are probably borrowing that.
Yeah, 100%. Yeah, so that's quite interesting. And does that apply to all lenders, the new DTI?
All banks.
All banks.
Yeah. So not non-banks. So again, you might see like a sort of shift of sort of higher DTI lending in non-banks. I think technically some of them do have like specialist sort of, the subprime near prime section where they might have slightly higher DTI, but generally they're good. And I think also they don't want to be lending to people that are really overburdening themselves.
Yeah.
But But of course, that's not the only thing that they can do to curb how much people are borrowing. We know we've also got that buffer in place. So you've got to be able to service a loan with 3% buffer over the carded rate. So that also limits how much you can borrow. But yeah, I was a bit like, actually, but given the house prices in Australia, like 6 times, I'm like, for most people, that's probably a normal sized loan.
Yeah. But so APRA what are they trying to achieve? They're just trying to sort of put the handbrakes on investor activity?
I think not necessarily investor, because it's for both owner-occupier and investor, but they are basically saying most of the loans that have high DTIs are investors.
Yeah.
And I think they're just basically preemptively trying to protect the market. So they're being like, if this gets a bit too high, we don't really love the risk that's involved here. So there doesn't seem to be any signs in the market at the moment of, a shaky financial system.
Yeah.
App is like, we just want to tap the brakes a little bit here.
Touch wood.
And just make sure that things are going okay. And of course, like they're looking at all the data coming through. They're seeing this DTI lending figure tick up. So they just released, obviously the September figures. So I think they're just like, oh, we want to see this come down because it is going up.
Yeah.
But yeah, I think that's pretty interesting. And I think also looking at other things that APRA have been talking about. This is really prudential regulation heavy. Sorry about that. But they've been doing a lot recently. So we've been covering it. Is looking at creating a new tier of banks. So let's get into this, Ben. We've been talking about this for a long time. Is Macquarie Bank a major bank?
Depends on how you're looking at it. I think there's cases for both sides of the coin. It's hard to think of a major bank without that sort of shopfront presence, I suppose.
Yeah.
But if you sort of look at their loan book and sort of what they're doing, you could also make the case that they're increasingly sort of fitting the bill.
Yeah. So, and I think that's totally right. Is, for most average people on the street, a major bank is one that they can go into a branch, they can, get their money out, they can deposit their money, whatever, but they can talk to the bankers, like they're used to that, and they see the presence in the high street. They have a physical presence. And I think that is always the main difference with Macquarie Bank, is that they don't have branches. So most people wouldn't really interact with them unless they're using them themselves. But of course, as you mentioned there, their lending has gone up a huge amount in the last year. And also just their assets under management now, because of that, really increasing, and the deposits increasing. They've had just a massive year. And for most brokers, they're like, yeah, of course it's a major bank. Like, we use them all the time.
Yeah.
So I think for brokers, they're like, well, yeah, when it comes to lending, they are like a major player.
Yeah.
But they haven't got branches. So I think it depends on who you ask here. But APRA is saying, because it's grown so much now, they actually want to create a new tier of regulation for what they're calling the most significant financial institutions. So currently we have 2 tiers for APRA. We have significant financial institutions, those are the bigger banks, and then non-significant financial institutions, so the smaller banks. Yeah. And they're saying, we actually think it might be a little bit unfair to have major banks being regulated in the same way as a smaller non-major bank, but is still significant. So I think in this sort of tier, I think the significant ones are maybe BOQ Group. Let me just quickly double check that.
So the second tier that...
So the significant tier at the moment includes the major banks plus some of the smaller banks. For example, ING Australia, Bendigo Bank, BOQ, HSBC. There's among them. But what APRA is saying, but the other ones are really, really, really big. They are the most significant financial institutions. Maybe we should be putting them into a new tier. So they're doing consultation a lot at the moment, saying, let's create 3 tiers rather than just having 2. Most significant financial institutions, significant financial institutions, and non-significant ones. And they want to put the 4 major banks plus Macquarie into the most significant. So in effect, they're being like, it's a major bank. And the reasons for that is they're saying, we want to create this tier for banks that have more than $300 billion in assets, which Macquarie does. So I'm like, I had been thinking about it a lot, and I'm like, maybe now we should start calling it a major bank, because if it does get into this new regulatory tier, in effect it is.
Does the new classification increase their regulatory burden, or would it?
So this is an interesting point. I don't know if they're actually looking at then adding on more regulation to them. I actually don't think they mentioned it, or if they did, I skimmed over it. So I don't recall seeing that. But basically they were saying, I think they may look at creating a more tiered approach to regulation. So they would have like requirements that would be, I suppose, really in this case, would make it easier for some of the smaller banks rather than kind of making it harder for the big banks. But I think they are basically being like, we just want to maybe tweak how we're applying regulation across all these banks. But they did say, so they were like talking about creating this super category, most significant financial institutions, so the major banks, which would be 5 lenders. Then there would be the significant ones, and they're also looking at changing the thresholds for that as well. So moving from 20 billion to 30 billion, which would mean that some banks in the significant financial institutions would drop down. So currently, for example, AMP, Rabobank, People First Bank, and Newcastle Greater Mutual Bank all have more than $20 billion under assets, but less than 30 billion. So if they did raise the threshold, they'd all drop down to be non-significant financial institutions. And that would leave ING, Bendigo, BOQ, and HSBC in that area. So you'd kind of have like three
pools.
Three pools, yeah. But I thought that was pretty interesting. Don't know if anyone else is interested in it. I thought that was interesting.
No, it is interesting, and something we've talked about. Like, as you said, we've talked about it a few times before. And just be interesting to see how the market evolves.
So they're going to consult. I think they're going to release the actual finalised proposals next year. So we've got to wait and see for a few more weeks. But yeah, I think generally they were kind of basically saying, we want to make sure we're reducing regulatory impost if we can, but also making sure that where there are really complex entities or really big entities, the most significant ones, that they're kind of, might have heightened requirements. So just really creating these distinct categories. So yeah, I think maybe come 2026, we might need to start calling Macquarie a major bank.
Yeah.
That's pretty much about it, I think, for the news. It's a lot to unpack there. Anything else you've been seeing this week that you thought was interesting? Anything else you've done this week that you want our listeners to know about?
Well, I'm not sure if it's out. I think it's out next week, but our January mag is out next week.
Yes, good point. It's got a beautiful pink cover. I don't know if it's in here.
I don't know if you've read it. But that's coming out. So
that has the cover is the Elite Broker ranking for asset finance this year. So that's pretty exciting. And that pretty much rounds off our main categories of the Elite Broker ranking 2025. So do check that out. That's in partnership with Optimized Aggregation. We also have a summer property report out.
Yes.
Which again, talking about property, we know it's been going gangbusters, has some really interesting stats in there. And then there's also the succession planning feature as well, which again, really interesting reading.
Yeah, and that was sponsored by Trail Homes. I chatted to Nick Young for that one. And it was super interesting to work on. So yeah definitely keep an eye out for it.
Keep an eye out for that. Of course, go back and listen to all the other podcasts as well. We've been releasing, we'll continue releasing them out over the holiday period. We are taking a little bit of a break though for what's making headlines over the holiday period. So we'll have, I think, 1 or 2 weeks without this weekly catch up. But we'll be back in 2026. But next week will be the final one before the holidays. Yeah. Well, have a nice weekend, Ben. And for everyone else listening, hope you have a great weekend as well. And we'll catch you next time for another episode on the Advisor Podcast Network.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.